All right, so I think we're good to go. And hello, everybody, and welcome to this week's edition of the Selfwealth Live Technical Analysis edition here on the 8th of April 2025. Here with Jason McIntosh to my right, Promotion Trader, and I'm Roger from Selfwealth. Welcome, everyone, to the show once again for another big week. Jason, how are you today?
G'day, Rog. I'm good. I'm all good today. Wild day yesterday, wasn't it? So we've got plenty to talk about with these markets. Certainly keeping things interesting for us.
Yeah, I think this is probably the first time since we've been doing this show that we've really we've hit this sort of streak of well, maybe 15% down that we are in the market now. So it'd be interesting to see how everyone's feelings are going. I'd love to know how everyone's on the chat's feeling at the moment. Put your comments in. If there's any questions, obviously we're always here to help. Well, obviously we can't help with which way the markets go, but if there's any questions, please feel free to do so. But it's great to be in this period as well, right? Because we can't just be always in an up phase. We have to be in this period and see how we can handle it and how we can deal with our own, emotions and strategies in handling these times, right? So to stay in the game. So fantastic. Hello, everyone. On once again that's saying hello. We are going to get straight into it because we do have a bit to get through, obviously. Jason, let's start with your disclaimer.
Okay, so everything today, general commentary only, no personal advice, and I'll quickly put on that disclaimer. We pop up each week, and that just goes through all that. General commentary, I'm not part of Selfwealth. I'm a promotion trader. You'll see my licensing and stuff at the top. Beneath there is the Selfwealth licensing, and again, the general commentary. All of that important stuff is in there.
Yep, fantastic. Now, thanks, Jace. Now it's funny because even the people that I don't really think in the markets, I went to the gym this morning and someone's asking me. They know that I'm in the finance review. Someone's commented to me for the first time ever, geez, those markets aren't looking too good. So when it's when other people are talking about it that you think you'd hear it, that there's it's big news right now, right? That the markets in general aren't going so well. But you know what? On the flip side, I think this is the time where there's all these people in the fundamental camp who are buying up where prices are down, right? So look, there's always positives to everything that's happening right now in the market, and it can present a lot of opportunities for us in the long run. Maybe not as trend traders at the moment, but I'm sure there's plenty of opportunities still that are arising from this big down period here. But let's have a look at what happened, obviously, over the Friday night and leading into Monday, right, on the Aussie market to start off with.
Yeah. Okay. So let's move over to our charts for the ASX 200, and well, Roger, we often talk about the bad stuff happening beneath the moving averages, and well, that's certainly been the case here. Last week we were speaking about the inherent vulnerability in the price structure, and that we had this shallow rebound off the lows, and prices consolidating below the declining moving averages, and this is where there's that higher risk of rallies being sold, which of course is what we've just seen. And I think the price structure around the moving averages, it's a really important distinction to understand. Buying at the dips, and you touched on that a moment ago, saying there's fundamental people going out there buying the dip now. Buying the dip, I find buying the dip works well when prices are above rising moving averages. Buying the dip doesn't work as well when prices are below declining moving averages, because of what I just said then. You have an inherent vulnerability in the price structure. Now, prices will ultimately bottom below declining moving averages whenever that may be. After any period, the low will be below declining moving averages. But buying a dip when there's a vulnerable chart structure, it does really, I think, exacerbate the risk and increase the possibility of getting caught in a sharp decline. When the structure flips, like, it's just buying the dip just carries that extra risk, and that's because the money flow often shifts from buying rallies to to selling rallies, and that's very much what we've seen the last week. So where does that leave us now? Well, what I want to do, I'm going to put on an indicator we've looked at, I think, a couple of times in the last few weeks. It shows us how far below the 50-day moving average. So that's the 50-day moving average, that red line on top, and beneath there's a 100-day moving average. This indicator down here, it shows us how far the market is below the 50-day moving average. And this was quite useful when we had this got to 6% below the moving average a couple of weeks ago. That was quite useful in identifying the potential for that bounce. And we got that rally over the course of a couple of weeks. There's that tendency to get those snapback rallies when prices get really stretched below the moving averages. And of course, this indicator is even more oversold now. So let me just compress this, and let's just look back, and just to make it easy visually, let's run a marker across. So this is around, let's see, this is about, say, 9% below the 50-day moving average at the moment. And if we just run this through here, and we can take it back a little bit further still. We can take it all the way. Let's take it back to the end of the GFC. So this is the GFC low back in 2009. And what you can see it's been, so just let's come back to current day for a sec. So here we are now at 9% below the 50-day moving average. And you can see when we just scroll this back, here's COVID. So this was got way below. That's an exceptional situation. But you can see there's several periods. There's actually 5 of them. There's 5 periods where where this indicator really gets to what I'd call washout levels, a washout of this sort of magnitude, and where it gets down to around 9% below the 50-day moving average. So it's interesting where we are now. Are we going to get a similar snapback rally to we have at previous periods where it gets this overstretched and then snaps back? You can see this has been the situation. Some of them get more oversold, others come back to this 9% and then snap back. So that's where things are at the moment. I think an interesting period to look at, it's this one here from 2018, and the ASX. This is a 15% correction that took place over a few months, and the leading issue of the time was again tariffs and trade wars, which is of course what we're experiencing now. So the tariffs that time around, tariffs back in 2018, they weren't of the magnitude or scale that we're hearing about now, but nonetheless, it's an interesting period. Let me just zoom in on that a little bit more. The market was coming off a multi-year high. Sharpness in the sell-off. It was an aggressive sell-off, considerable panic. And it played out over several months. So you get the initial sharpness of the decline. Wasn't, we got a snapback rally, but it wasn't a snapback to above the moving averages. It still took several months for that to play out. So, of course, what we're going through now, it's going to be different. It always is different. There can be similarities, but they're always different. There's each pullback or correction, it charts its own unique course. And the decline we have now, so this was 15%. Let's just go back to current day. This is 17% at the lows yesterday, so it's already a little bit larger. But nonetheless, it shows that it's an example of how a period of considerable uncertainty doesn't necessarily have to lead to a long-lasting bear market. So it doesn't tell us what's going to happen next, but it just helps frame our expectations around what possibilities could play out. So let's just remove this, because this is showing this oversold position we're currently in, and it does look like we are getting that bit of a rebound coming through today. So let's just take that off for a sec. This does appear to be a very oversold market. There could be, I think there's a good chance of a strong rebound sometime over the next week, but it's not the sort, and this is interesting because I'm hearing all this chatter through the media on the radio now. Should we be buying? Should we be selling? It's not a rebound at the moment. It's not a rebound that I'm ready to buy. I think we could see further volatility before this is over, just like we saw back in 2018. So there's that initial sharp volatility, but then there's a whole period of messiness and instability in the markets before a final low was actually put in. Yes, you can get V-shaped recoveries. It's entirely possible, but I'd want to see a bit more positive price action before saying, okay, I think it's time to get on board. We've spoken a lot about reducing risk over the last few weeks, and about not letting losing stocks get away from you. I think an event like what we've just been through, even if you've been reducing risk and you haven't been letting losses get away, this type of event, unless you're completely out of the market, it's going to result in losses. But hopefully, by having good preparation, it's this period has been a little less emotional than I think it's probably been for a lot of people who really haven't had much planning around their portfolio over the last few weeks as the market's been pulling back.
Yeah, very, very true. All right, well, obviously, there's not much else to be said about the Aussie market. Let's just see if this rebound of entry rates. Of course, the ability to know when market structure has changed is super important, and we've been talking about this over the last few weeks just to see this shift in market structure. So it's good that hopefully everyone online and big class knows this shift and knows this sentiment. It's the same in the US market. Let's have a look at that. Now, obviously, that's over 20% down. Are we in a bearish market now here? Are we technically in a bear market?
Yeah, well, a 20% decline qualifies as a bear market, but like how long will a bear market last? Like the COVID bear market was, I think, the shortest bear market in history, and then you get other bear markets that go for 2 years. So it's really just a terminology around the percentage of the decline rather than telling us what to expect going forward. But yes, 20% decline is a technical bear market. So Monday was the this drop on Monday. That was the single biggest day's fall in the S&P 500 for nearly 5 years. You've got to go back to actually over 5 years. You've got to go back to the worst days of the COVID crash to find a bigger decline than what we saw on Monday. And another alarming statistic is that the S&P 500, it's down from where it started the year, from January 1 through to where we got to the other day or probably yesterday. S&P 500, it's down 13.7% in the first 64 trading days of the year, and that makes the sixth worst start ever. So there's some pretty bleak numbers when you look at some of the statistics that are coming out of the last week. Like we discussed with the ASX 200, this is why we shouldn't be messing around when prices are consolidating below declining moving averages. So I know this has happened, and if someone's ignored this situation, it probably doesn't help. Well, it doesn't help so much now, but it does help with just like we make this point all the time. The bad stuff happens below the moving averages, and yet again, that's been what has happened. So I think the better we can understand price structure and what to look for, I think the better position we are moving forward, in that it just creates that vulnerable structure and elevates downside risk. Doesn't mean every time a price, whether it be a stock or a market, gets below the moving average, it doesn't mean it's going to crash, but it's as I say, a position of vulnerability. It's different to a dip back to the moving averages. It sets up the potential for trouble. But what do we do now? Should we be buyers here? Should we be selling? And from my perspective, when I look at this, I think it's mostly now about not doing much at all, not doing much buying, not doing much selling. We've had a significant panic-driven decline. Individual stocks, I was looking at stocks yesterday on the ASX, individual stocks, they're moving by 10% in a day. So that's a crash. It's a crash when you get that sort of move. And that's a sign of people just wanting to get out no matter what. Just say, okay, press sell, whatever price is there, that's good for me. That's complete panic driven, get me out. And if I can avoid it, I don't want to sell at panic levels. As we've spoken about, and we've discussed this over the last few weeks, I I sold. I started selling when we had just after this false break higher in February. We talked about this. Talked about selling that initial false break, selling when the market started falling below the moving averages, selling into the rally, and then selling the early stages of this decline last week. But one thing I didn't do was I didn't sell a single stock yesterday because yesterday was just a day of panic. And if you can avoid panic selling through preparation, I think that's the way to be. So having that trading plan that helps you prepare enough not to have to sell at any price, I think that financially, emotionally, it just puts you in a much better place. I have sold a couple of stocks this morning, but my selling this morning was at much better levels than I was going to be getting yesterday. And I'm pointing to the S&P 500, but the selling I was doing was on the ASX this morning. And it's like avoid. It's such a big thing, Rog. Avoid the panic at all costs. Sometimes you get swept up in other people's panic because stops are going off and you've got to take action. But if you've prepared your portfolio well enough, it does give you some more flexibility to say, well, look, things have gotten excessive. I can take some extra risk of maybe getting a snapback rally, selling into that, and I think it just puts us in a better position. I think that the play now, I think the markets are oversold and that we could see that strong snapback rally we've discussed. I think that could be the opportunity to exit any stocks that should have been sold earlier at better levels. But as for buying, I just think it's too early. And when I say selling stocks that should have been sold, it's not like liquidating the portfolio. I've got stocks in my portfolio which are still comfortably above their trailing stops. I'm not looking to sell them into a rally because they haven't given me a reason to sell. But stocks which have come back to exit points may have gotten a little bit through there. I'm looking to just there's only I think I've got one more buy order in the portfolio at the moment. Got rid of two this morning, one just before we went on air, and there's another order sitting there to just tidy some odds and ends in the portfolio. And then everything left in my portfolio are stocks which should be in the portfolio because they're above their exit levels. But as for buying, whether it be the ASX or the S&P 500, I just think it's too early. I don't want to step in front of this sort of volatility and uncertainty. Going off some of the sentiment readings which I'm seeing, this could be as bad as it gets, but we just don't know because bad can always get worse. Now, I'm talking from like a tactical sort of perspective mostly around individual stocks. Like, I've got longer term ASX 200 ETF holdings within super funds that I haven't touched, and I'm not looking to sell them in the rallies. Everyone's got to work out what their time frame is as well. So for all my medium term strategic positioning, well, I've been using my trailing stops, been keeping that nice and tight. We'll tidying it up to keep the portfolio where it should be. But people with longer term positions, well, that can be entirely different with the way they're held. The fact is, I'm not going to call the low. I'm not going to get it on the day that it bottoms out. My focus is on waiting for more evidence that a low is in, and then the odds of buying become more favourable. It's for me at the moment, Rog. It's just simply too early. A lot of technical damage done during this sell-off, and it probably takes time for that to repair. But this is a really important point to remember. So all that bleakness at the start about this is the biggest fall since COVID and the sixth worst start to the year ever. Don't forget though that every tough period leads to new profitable opportunities, and from that perspective, like, do we think this is the highest the market will ever be in the history of time? Has it peaked out forever? Well, highly unlikely. So at the moment, from the lows to the highs, there's 27%. So at some point, whether it be from this low or whether it be from a lower low, there are terrific opportunities back to new all-time highs at some point in the future. But the key is we need to protect our capital when it gets tough, and just be patient. It's okay to sit there and watch. Don't need to get the ding dong low. Buy at the lowest point. wait until the odds start to shift back in our favour, and then we try and play that recovery back to new all-time highs and beyond, and that will happen. Of course, almost certainly, nothing is 100% for certain, but it's got to be pretty diabolical if we're never going to see new highs in the markets again. So I think those great opportunities are going to be there, but we've got to be patient. We've got to wait. Don't lose focus on your trading plan, on your strategy. Stick to your rules and wait for those nice clean shots to come back.
Yeah, it's perfectly said, Jason. And as active traders, that's what we need to be training ourselves for these down periods. If you're a passive ETF investor and you're watching this, it's probably not so much your show, because at the end of the day, you can just sit on your ETFs and not worry about what's going on with them. They'll track the index and they'll do whatever they do, right? But if you're an active investor, like what this show's all about, active trading, then the ability to have that resilience in these periods and follow your plan and stick to it is so important. And one of the other things that I found quite interesting yesterday in that big sell-off over the weekend or the Saturday morning our time, was as a snapshot of orders within Selfwealth. There was actually a lot more buy orders than what there was sell orders at that point. So as we might be looking at opportunities on the trending markets, there's, as I said at the start, there's a lot of people on the other side on the buy orders looking at opportunities now that the market's down, right? So that also gives you confidence that there's always two sides to the story, right? Doesn't matter what the charts look like as well, right? So but that, it's important that we have that plan ready to go when the markets do turn up again at some point. But
what was it? I did see some interesting statistics this morning from the US market that there's been more retail buying of index ETFs than selling. Retail buying often isn't associated with lows. Retail buying at lows is often low because people have lost confidence in the market and they don't want to know about it anymore. That's when lows typically form. When there's enough confidence for a flood of retail buying to come in, it may not be the best of signals, because like retail buying gets conditioned during an large upward move that buying the dip always works. And that's when we've got the rising moving averages, dips back to the moving averages. They tend to work quite well. When the structure changes and people don't realize that because they're not focused on things like moving averages and structure, they're just conditioned to buying a down day because it always goes up. That may play out over the fullness of time, but it may not be a good indicator of a near-term lasting low. So it's just something interesting to consider around who's buying and when they're buying. Retail doesn't have a great record of identifying the lows. It's all the studies seem to show retail is good at buying up here and selling down here. And that seems to be how it often plays out. So it's going to be interesting. The buying you mentioned, Roger, kind of supports some of the stuff I've been looking at today. So it's that's why I say for me it's just a bit too early to see. Just want to see some good signs that there's like we're getting these buying thrusts where you get a whole lot of buying coming into the market and pushing prices up. So we don't get a muted bounce like we got a week or two ago. It's more a strong bounce on high volume. That's a sign that the big money flow is coming into the market. We don't have that yet.
Yeah, we're gonna have to wait for one hell of a big a live cap bounce from here, I think. So let's wait for that. All right, let's have a look at the Hong Kong market, please.
Yeah, well, hasn't this been a swift about face? What appeared to be a steady pullback towards the moving averages has quickly given way to a full on crash down. It's over 10% on Monday. Wasn't helped by the fact that there was a holiday in there on Friday. So that trade you can see on the 50-day moving averages was on Thursday. No trade on Friday, and then so that's why this is exacerbated in one day. It's really interesting how, like, all this way through here, through early to mid March, the Hong Kong market was really ignoring those you know that growing uncertainty that we were seeing in the US and the ASX, and the same was the case in Europe. It was like, and I'd said at the time, like I was saying, at this point, this isn't a global sell-off. It's certainly become global since, particularly in the last week. But it took a while for this to really to to fall into sync with what was going on locally and in the US. Um, I thought we had a positive price structure here with these rising lows, rising highs, controlled pullback to the moving averages. But this collapse we got yesterday, that just takes that all out of the picture at the moment. A lot of technical damage done. It's probably going to take time to repair. So yeah, for me, this is just another market where it's now into just in the avoid category for the time being. Nothing to do here, and the same situation in China. This was always out of sync with Hong Kong. It wasn't getting that same strength of the rally, and we had the same issue last week. We were talking about that. It just wasn't holding on to the gains and sitting around the moving averages, and now it's just let go to the downside. So the sharpness of this move lower again, it just we've got to let the dust settle now. Is this like a one-off like panic low before it like stabilizes and pushes up, or does it develop into something else? I just don't know at the moment. We don't have a dominant trend one way or the other, so I'd just be leaving this one alone for now.
Yeah, fair enough. All right, so I actually had this question myself, and we'll start off with this one. I think it's a good one. Even I am looking into opportunities to sell the rally at the moment. So, can you give us an example of maybe one of the ones that you sold into the rally yesterday or today?
Um, yeah, well, and you asked about this one last week, Rog. TUA. So this hit my stop yesterday, just on the open. So it opened just below the stop, quickly came back from the stop, and so I was just happy to leave that alone yesterday because it was moving back higher, and just today it's just yeah, completed hit my order, put a order in it. I think it was $5.07, and it's just hit that before coming on air. So yeah, rather than sell the gap, like you can see, we've got a gap down to a low. Rather than sell the gap, I've sold it on the rebound. Um, it's not too many stocks I'm looking to do that with because I did tidy up a lot of the portfolio on the as prices have been pulling back, as we've discussed at length already. But yeah, if anyone stuck in a stock, like this is a sort of rally when you get those multi-day rallies. They give opportunities like this. This is the ASX 200, but it could look like an individual stock could look similar, where it has an aggressive move down, and then it does have that rally back towards the moving averages. We see that sort of structure quite often during declines, and and this is why it's called sell the rally. It's buy the dip on the way up. It's sell the rally back to the moving averages on the way down until you get a change in trend and prices are back above the averages. So again, I'm not talking about like liquidating a portfolio. I use the next rally to sell everything because maybe the final low's in, so you don't want to be selling everything after the final low. But it's a case of, for me, it would be a case of just tidying up some stocks which may have been difficult to sell on Monday's panic, that now you get the opportunity to be able to get a more reasonable price as a bit of buying comes in. And maybe you can put an offer in and someone hits the offer rather than you having to hit a lowly bid when there's not much interest in buying.
Yeah. All right, and this probably leads on to the next question. And we've answered this, but at the end of the day, it's always good to reconfirm. Are you setting alerts around any of these things, or are you just putting stop losses in the system?
I don't put stop losses in the system. Not that there's a problem with this. We've discussed this before. If I'm trading something like a futures or a CFD or something with leverage, I'll have a stop in the system because it's leverage. You've got to be extra careful with leverage because if leverage gets away from you, it can blow up. So you don't want that to happen. So that's where active stop loss is essential. When I've got a portfolio of many stocks, like could be 40 to 80 stocks, each stock might represent 1 or 2% of the portfolio. I don't feel I need that active live stock because I can just manage each stock individually, and that's what I've been doing. So I'll usually look at the end of day data and see what stocks have hit their exits through the day and sell them the next day or soon after. In a fast moving market like we've had recently, I'll be looking at it more through the day and seeing which stocks are falling, which stocks are near their stops, and manage them accordingly. So it's a little bit more work doing it that way, but I just then have a bit more control over the sale price. It can be, and also because I'm trading smaller stocks, liquidity is not as great. So if I put in a stop loss for a small to medium stock at say $1, might trade it, hit $1, trigger the stop, but then there's only like 1,000 shares on the bid at $1. There's 2,500 at 99 cents, and then it drops down to 97 cents where there's another 2,000 shares. By the time I've sold maybe 10,000 shares, I've let some go at 90 cents. So I feel I've got more control over the process when I'm managing it myself, and rather than having those active stops. But everyone's got to work out what works best for their own portfolios and their own risk management process.
And obviously lifestyle as well, right? If you don't have the ability to be there, obviously stop losses on the Selfwealth system, they work for me. Like I've put them in, but I use a combination as well. Like I use a combination of alerts, knowing it's getting closer to a level, and if I know that I won't be there at a time, then I might end up putting a stop loss in, and they certainly work. But you've got to manage that stop loss as well, because that order might not go through 100% of the time, right? You've still got to manage that once the order's in the market, you still may need to manage that stop loss, right? So just to be wary of that. Got some great comments here, and one from Neville. I haven't seen a bloodbath like this since I watched The Last Samurai starring Tom Cruise, but he survived, and so will we. So there you go, yeah, of course. Very Michael has obviously been a great student of ours in terms of very wary of the fundamentals. What goes down can go down even further. Yes, we know this. We definitely need to be wary of this. It's a good curve. He says good time to be identifying stocks showing relative strength, as they will be the leaders when the market turns. So that's also a great sort of bit of piece to do a bit more. Maybe as you said, Jason, sit on your hands a bit, do a bit more education, and learn about companies that are out there that you might be interested in as well, right? So plenty of stuff to learn. All right, let's get on to some of.
And Michael makes a great point about what goes down can go down further. It's like, particularly with individual stocks. So people who like to maybe they're long-term ETF holders, and they're just they're happy to buy some ASX 200 ETF at current levels and say, well, I'm looking 10 years out. So if it goes down for the next 6 months, goes down further, it's not such a big deal because I'll average there. That can work well. Averaging into something like the ASX 200 can be part of a solid plan. I think averaging into an individual stock is another matter, because the circumstances around that particular stock can change. And while it's unlikely the ASX 200 is going to fall 90% over the next year or so, of course anything can happen, but it's unlikely the ASX 200 drops 90% in the next couple of years. If you buy the wrong individual stock, it certainly could drop 90% over the next couple of years, or it could even delist. So averaging down into individual stocks, I think, carries a lot more risk. So if you like averaging down, I would generally suggest considering it with an index rather than an individual company, unless it is like a big and incredibly strong company. But anything can change, anything can happen. So I just wary about with individual stocks when you're trying to take advantage of market volatility. You don't know what's going to happen. Look at some of those big American banks during the GFC, like banks which had been around for 100 years, top tier banks, so went out of business and their shareholders lost everything. So yeah, you don't want any hubris around individual stocks because it can change. Average ETFs, average indexes, I think, not individual stocks.
Very good. A few more comments here. Confused. I just going from bullish to bearish every 5 minutes down under. Well, hopefully some of the commentary we've done so far, Kev, is helping you a little bit around the confusion. And yes, Maku's 2018 tariffs, trade wars, and Trump. So it seems to be that everyone's blaming Trump for what's going on at the moment. Poor guy, right? So, all right. Let's move on to some tickers then, hey? Let's have a look at the first one on the list here from Kirby. WGN, please. WGN.
Relative strength. Look at that. Despite all that volatility, this is holding up really well. Uptrend back to the moving averages. Like, I don't want to buy it at this point, even though it's been relatively strong. Like, it's a lower liquidity stock. If someone decides they want to start selling a significant portion of it, it's like it could quickly come apart. But if I owned this one, if it was in my portfolio, I'd be happy to hold it. You know, my wide trailing stop would be in place. That's how I'd handle it. But it's a good example of a stock showing relative strength.
Very good. The next one from him is SSM.
What was that? SSM.
Yep.
Yeah, this is another motion trader stock as well. So Wagner's WGN's a motion trader stock. This is a motion trader stock. I've got this one myself, and as I said earlier, it's not a case of using this any potential rally in the ASX 200 to sell my whole portfolio. I don't have an order in to sell Service Stream because why would I? The share price is generally holding up. It's pulled back to the 100-day moving average and it's rebounding. So this trend is still in place. I'm using a wide trailing stop. It's well below the market. It's been well out of range of the volatility which it's seen, and that's the whole point of a wide trailing stop, to see off survivable volatility. Some volatility gets too great and it's shut risk down, but at the moment this is within the parameters of reasonable volatility. This trend remains up. The best gain stocks make their best gains when markets are generally moving higher. So whether there's a whole lot of upside of this in the near term, it's probably less likely. But there's no need to sell it. Hopefully, at some point, this market volatility settles down and we get a more benign trend, and a stock like this can continue to do well. So for me, it's a stock I want to keep holding.
All right, fantastic. A couple of good examples of stocks holding themselves up there. SFR.
So this is a copper stock, and it's probably had a bit of volatility because the copper price was looking really good until about a week ago, and then it's completely come apart, and that's now. So copper stocks, you've got the general market volatility and what's going on in copper. So this would be. Let me just see how far this is pulled back. Like, this would be getting at the outer limits of where an exit, where a trailing stop would be for me. Like, even if I was in at a good level, it'd be getting. I'm not sure whether it triggered the motion trader trailing stop yesterday. Like, I think it would have gotten pretty close. Quite a few stops have triggered exits in the last couple of days, not surprisingly. If I was holding this now, well, it depends. Has it? If it had triggered my stop, this could be an example where I could, sell into a rally if I just wanted to shut down some risk. If it hadn't triggered my stop, well, then I'd continue holding it, but I'd suggest my stop would be pretty close below the Monday's low. A lot of damage done to this trend. It's more than just a just a regular pullback because it's so deep below the 100-day moving average. You can see these other periods where it's pulled back below the moving averages, but doesn't get too far below it. This is a real drop. So the risk now with this is that it does rally, but the rally doesn't have much to it, and the moving averages start trending down, and then we've got that same situation of a muted rally towards declining moving averages. So it opens that window of vulnerability. So it's a stock which was looking really good, which I've now got concerns about. It's one to watch closely and just be aware of the exit plan with this one. But I think there's scope for a bit of a rebound towards the averages, but I think it might be difficult for it to re-engage that previous uptrend in the near term.
Okay, next one's ALC.
It's a stock which was looking really encouraging, which has quickly just lost that momentum and lost that positive chart structure. Like if I was holding it, I think a break below yesterday's low would probably be a sign, be a time to sell it. It's rebounded off the low, so if it can hold yesterday's low, well, maybe I could give it the benefit of the doubt and see if it can start to get back above its moving averages. Because it still looks like a stock which could base around these levels. You can see this large decline it's had, and it does have basing looking qualities, but I think it really needs to hold yesterday's low, break below yesterday's low. It just opens more downside risk, and I'd probably want to be closing it out.
ARU.
Holding up reasonably well. It's a lower price stock, so these are larger percentages, but it's still got this general sequence of rising lows in place. Again, I think yesterday's low is probably a bit of a key point. Below yesterday's low, then maybe there's more unwinding of this stock to come. But if it can hold that and get a bit of a rally over the next week or two, then maybe something can develop from it. But yeah, low price stock, it's it's certainly not a high confidence stock for me at this point. But yeah, at least we've got a clear. I think we've got a clear parameter to watch. Yesterday's low.
Okay. The next one is Life 360.
Well, this was a motion trader stock which had done really well, but it hit its stop loss. I think it might have been a couple of days ago. So this is an example of one where I'd be looking to use any rally as a better exit point. And this has been a great stock. So this has been in the motion trader portfolio for a long time. Might have gone back into 2023 even. Lovely gain, lovely trend. All these regular pullbacks to the moving averages. While we have wide stop, we can just see those off. But then at some point, the pullback becomes to a point which can't reasonably be seen off, and that's happened in the last couple of days. So we are getting this rebound off the low now, but again, this would be a rebound. I'd be looking to sell this stock because the structure has changed. We've gone from above rising moving averages to now below declining moving averages. So this is now, from my perspective, it's a sell the rally stock, not a buy the dip. And if it rallies a bit and someone were to sell and then it keeps rallying, well, yeah, that can happen. That can happen sometimes, but it's not the stocks that recover that cause the problems. It's the ones that have a rebound and then re-engage to the downside. Alternatively, if you want to give it the benefit of the doubt, well, again, you got yesterday's low. I think if yesterday's low were to break, well, that'd be another selling point. So maybe someone could give it the benefit of the doubt, see if it can retake the averages. But if you're using yesterday's low as your exit point, then you remove the prospect of just selling at a better level on the rebound. So it depends what people want to do. Could be a couple of ways to play a stock like this. But yeah, below yesterday's low, I'd definitely be exiting, because I don't want to run the risk of a stock that continues to unwind, and then we look at this in 12 months' time and it's down at $6 or $4 or something lower. And I've seen this many times where, here's an example here, where the stock had a great period during 2021, and then we're below the moving averages, consolidating below the averages, and then we get this lengthy unwind, which took it down, maybe 80%. So I don't want to be in that position. So that's why I'll have a definitive exit point on this stock, whether it be selling into the rebound or cutting it below yesterday's low.
Yeah, I've got a couple of positions in this same similar. So I'm glad you mentioned the whole point. If it breaks that yesterday's low, that's your hard. That to me is your hard stop. But giving it a chance to be able to sell in the rally is a good way to look at it as well. But yeah, having that hard stop, I think it's good.
Like we can use this as the example here. It's like you can look at any of these low points as sort of like as a line in the sand for how long am I going to give this stock to have a good rebound, to either keep going, to retake the averages and move higher, or not. And like if you use any of those points, you just like travel along from any of those lows, they become your get out points. So it's your fail safe, so you don't get stuck in a stock that continues to unravel. So let's just measure it. What was that? That was, well, I said 80%. It was 83%. So why ride a stock to an 83% low when we can get these points to say, look, okay, it's triggered the stop. For whatever reason, I didn't sell. I'm getting a bit of a rebound. I'll give it the benefit of the doubt. But if it comes, retests the low and breaks again, I'll just say, hey, enough's enough. I'll, hopefully I'm in good levels. I'll take a nice profit, not as much as it was, but it's still a nice profit, and I'll walk away rather than risk giving the whole thing back and being down and out on yourself because you've given back a great profit and now you've got a stock that's down 80%. Completely unnecessary, and I think completely avoidable if you just have put some structure around what you're doing. And yeah, a bit of an each way bet at the moment with this one here. So yeah, let's see how it plays.
All right, next one's from Jennifer. NCK, please.
Sorry, what was that, Rog?
NCK. Good couches. I know I've got one.
Yeah, and it's kind of like, again, we've got this rebound off the low. Like, now, I don't know what's going to happen here. Are the markets are we going to have a V-shaped recovery? It was yesterday the day of capitulation. It's entirely possible. Yesterday had all the hallmarks of capitulation selling in terms of like, that wild price structure where stocks are down 10% on the day. So was yesterday a capitulation low? And now we're going to see a strong recovery. Like, I don't know. It's certainly a possibility. So like holding a stock just going back to what we were just saying with 360, it's I'd probably use yesterday's low as my reference point now for what to do. If it can hold yesterday's low, well then I can give it the benefit of the doubt, see whether it can reclaim the averages. Or if I want to shut down risk, I can use and move back towards the averages as a better selling point. Or I can say if I don't sell and it doesn't kick on and instead it comes back and it breaks yesterday's low, I can just scale back my risk with an exit. So there are a few ways to play it, but they're structured. None of it's around holding and just crossing your fingers and hoping for the best, because you got to plan either way. You've got to plan if it kicks back nicely, and you've got to plan if it stalls and starts to fall. I think that's the way to play Nick. It's not a definitive end of the trend at the moment, but it's like I don't want to see a series of lower lows develop. At the moment, you could say, look, that's a zigzag pullback from the high, but it's really got to hold the line now and start to make some positive headway, or it starts developing a series of lower lows, and that's where the risk of the whole thing unraveling really starts to increase in probability.
Yeah. All right. VAU.
Yeah, benefit of the doubt for now. It's still holding the 100-day moving average. Let's see what it can do. Let's see whether it can hold here and push back up. I'd be using my calculated stop loss or trailing stop for this one, which will be like comfortably below the 100-day moving average. Excuse me, below the 100-day moving average. So at the moment, this for me would be a hold.
I mean, using this as an example, and if you wanted to buy it, what level, what areas would you be looking at this if you really wanted to in this environment?
Well, look, it could be bought today, and stop loss could be below yesterday's low. So if you really like this one, you say, okay, I'm gonna punt. It is a punt. I'm going to punt that we've got a panic low yesterday, and that's going to hold. So I can buy this stock, and I can have a 7% stop loss. And if it rallies, well, if it gets back to the just gets back and makes a new high, I'm up 15%. I've got 7% of risk. It's still above rising moving averages. I think I can take my chances on that, and so that could be one way to do it. Alternatively, you're looking at like what the next rally looks like, and then what the consolidation after that looks like. So if it has a nice strong rally, and then it pauses and consolidates and holds onto the gains, then maybe you're buying then the subsequent break to a new high. So there's different ways it could be done. The more aggressive one is just buying now, close stop. The more conservative one would be let's watch the price action, see if we can get a rally, a consolidation, and then a breakout. And that's there's less risk, I think, with doing it that way because you're getting pulled in with more positive price structure. Doesn't mean it's definitely going to carry on. A lot of these, you can get some nice initial setup, which then goes and fails as well. But I probably prefer playing it in that way at this moment. I want more positive price structure. And that's what I was saying with the ASX 200. We can punt the low now and put a stop loss below yesterday's low, or we can wait for more positive price structure and try and take a little bit more risk out of the situation and try and get the odds a little bit more favourable. That's why I prefer to do it at the moment rather than going for the hero trade of trying to get as close to the low as possible.
Okay, all right, great. Let's have a look at ACF, please.
Yeah, this is a motion trader stock. Triggered a signal in early Feb. So this was a great trade last year, which came to an end when it came back and hit the stop loss in August last year. And then after a period of sideways price action, looked like it may have been re-engaging with momentum in early Feb. But this is the thing: momentum doesn't guarantee success. It just brings stocks of interest to your attention, and some of them will go on with it, some of them won't. This one then quickly came back below the moving averages, and now it's been caught up in this ongoing volatility. So if I had this one, I'd probably be looking to let it go. If it hadn't hit my stop loss, it'd be coming up to my time stop. Give stocks a couple of 60 trading days. If they're not in positive territory, I wrap them up. This would be probably coming close to that. So it's one of those ones where maybe the rebound could be the opportunity to just square it up for not much damage. It's hard to see really positive price action at this point coming from this stock. It would really need to, if it broke above the March 28 high, so this high from a few days ago, that would be a sign something interesting was happening. But whilst it's below there, I think the odds are now shifting to, like, at best this is just a holding pattern.
All right. Next one along the line is NZM. JG, it's for you here.
Yeah, it's had a nice breakout with this stock. You can see it got above all this resistance. It was stuck below for a year, stuck below resistance, broke higher in February. So this is a New Zealand-based media company, if I remember correctly, and so and that was looking good. And I almost bought this one myself, but didn't, just because we just had that market volatility was coming in, where I said, look, well, I've been talking for a few weeks about being more defensive, so I was slower to buy stock. So I had the signal for it, but I was just hesitant to pull the trigger on it, and yeah, now it's just started to. It's like the breakout's failed so far, but like, has the breakout failed because of the broader market volatility, or because it was going to fail anyway? It's like, there's probably a confidence issue with the market at the moment. So if I had bought that stock, I'd still be holding it. I'd still be using my initial stop, and just see whether it can unwind those losses from yesterday. Because until yesterday, it had been holding up fairly well. So I wouldn't write this one off just yet. Although it's not great to see it back below this breakout point, but it's not like it was on a quiet day in the market and it just came down of its own accord. It's come down due to general panic. So the key now would be, can it quickly reclaim yesterday's losses? If it goes and makes a new low, and then it's a case of maybe this isn't just going to play out at the moment. But just for now, I'd give this a bit more time, and yeah, as I say, see if it can recoup yesterday's losses.
All right. KNB. K and Finelli and B.
Yeah, low price gold stock. Yeah, if I was holding this, I'd be happy to continue holding it. We've got that upward momentum there. The moving averages are rising. It got a bit stretched above the averages. It's pulled back a bit. Maybe if it consolidates for a bit, like we saw during February, early March, maybe it sets up for another run. But it's like, it's interesting because, like, just looking at the price action from earlier times, you can see how patchy it is. So you can tell, it's thinly traded stock. But it's interesting looking at the price action just over the last couple of months. You can see there's a lot more fullness to the price action. We don't have all these dots anymore. We've actually got ranges. So it looks like it's becoming a more traded stock. So why that is, I don't know why there's more interest in it, but there's certainly more interest in it. It's now above the moving averages and rising. So you never know. There could be something going there. So I'd be, as I say, happy to hold it, stop below the 100-day moving average, and see what happens. I'd probably be watching it rather than buying it if I didn't have it. But yeah, see what this consolidation looks like. Maybe there's a speculative play in the makings.
All right, I've got a couple of viewers asking for OCC.
Yeah, it's interesting, isn't it? This is real relative strength in a stock that had run so hard to hold in so well in the current environment. It's a positive thing. If I was holding it, I'd be happy holding it. I'd be using my wide trailing stop, which would be below the 100-day moving average. It's been quite volatile, so it's going to be wide, like an ATR stop would be. I think yesterday's low is an interesting point. So if it were to break yesterday's low, that'd be an early sign that maybe it's not going to be able to continue to hold on to all these gains. But I'd be using my wide trailing stop, but that would be below yesterday's low would be, like we've spoken about with everything. It could be a sign that there's more weakness to come. At this point, this is a sideways consolidation of a previous strong period. So happy to let profits run in this situation.
All right. NMG.
Really low price gold stock, 1.4 cents, but it does have that positive trending characteristics to it. Look, this isn't a stock for me. It's like 1 cent stock. Uh, but I don't know what they're up to. I don't know what they've got. And some of these low price stocks, anything can happen. They can go on great upward trends, and the building blocks of a trend are there. We've got rising lows, rising highs, price above the moving averages. It's doing its own thing. It's not swept up in the broader market volatility. So yeah, I'd be happy hanging on to it. If I really liked it, this is probably the time to buy it, just as it's pulling back towards the top of the 50-day moving average. But it probably requires a fairly wide stop. That's the problem with the low price stocks. Look, yeah, maybe it's about 35% stop in a stock like on a 1.4 cent stock is probably almost as good as you're going to get. So yeah, interesting speculative play.
Okay, we might have a break from some figures. I'll answer some general questions. Do you mind commenting on what you think the difference is between Hong Kong market and the China market, Jason?
I don't know. Actually, I don't know. There's a correlation. You can put the two on the chart, and you can see there's a correlation. But why one will accentuate a move and the other one won't? Yeah, look, I just don't know, Rog.
Yeah,
It's not a part of the market I really focus on. I look at price action. I don't worry so much about why one market's not. No. Sometimes when one market's not confirming the other, it can be a sign of divergence and maybe a sign to be aware of, and it's something we've talked about with the Hong Kong and Chinese market in the past. But actually understanding the reasons behind it, it's not something I do. I'm price orientated. I don't need to know why. I just need to know what's working, and then I can manage risk around what's working rather than trying to understand every detail of why.
yeah. I mean, obviously, I kind of knew that was going to be the roundabout answer, and I think I actually was on a webinar with another credible financial advisors, and the question was asked: what in these recent times, why has it been that Hong Kong has sort of been the one that's flourished and China hasn't really been doing much? And I don't know if this is the case, but once again, we are just talking in general, obviously. But the response around that was around the technology stocks in Hong Kong seem to be ones that were really helping boost that market up during that time of that bullish period, and China wasn't doing much, right? Obviously, the main difference is that the companies are domiciled in China versus Hong Kong and whatnot. But in that recent time where Hong Kong was rallying, it seemed to be a lot around the technology stocks in Hong Kong. So I thought I'd just add that in as some education that I got. All right. The next, can you just confirm what time your show is on a Friday for Jennifer? He's already got an answer there, 1 p.m. Is that right?
What the live motion trader strategy session is at 1:00 on Fridays. That's Eastern Standard Time, Sydney time, 1:00 Fridays.
Thanks,
And
Andrew.
you need to be a strategy session member to be able to join the live. Otherwise, you get a link for the replay on Saturday morning.
Yeah, thanks, Andrew, for answering that. And good to see you're sticking with the process, the MT motion trader process. All right, let's have a look at the other question is around shorting. Do you think it's a good idea to be shorting stocks now or shorting indices?
Probably not now. The time to have shorted was probably maybe this time last week or even earlier. It's like everything's so clear in hindsight, isn't it? It's like shorting's hard because sometimes you're short and the market just comes roaring back like we could have said, okay, look at this break. This is during 2023. We've got a breakdown. It's just closed below support. Let's get short, and then the market comes roaring back. Trading short is hard, or you get short as the market dips below the 100-day moving average, and then you're doing okay for a couple of weeks, and then you get this quick short covering, and rallies back to the moving averages and then falls. So it's shorting. Shorting is it sounds like it's a free kick because you just got to find something that's going to fail. Surely that's got to be easy, but it's not, because you get these sharp reversals that come flying back at you. It's in hindsight, the day to have shorted was throw out some shorts when we had this failed break. And I've thought about this myself a few times, thinking I closed out an S&P 500 position. Why didn't I just do a few shorts as well? But it's all clear in hindsight. It's like the COVID crash. When we look back at it now, we should have all sold on day one when we started hearing about the first cases. But the selling went for several weeks because it's like, well, it's clear after the fact. It's not clear at the time. So I don't do a lot of shorting. The mass favours buying. A stock can go up infinitely, but it can only fall by 100%. So you got that asymmetric advantage towards being long as opposed to being short. Sometimes shorting works. In my experience, I just find it's just harder. It's more volatile. But there's nothing wrong with like having a good think about it. If you can get the right points, it can help hedge your portfolio. You get some inverse ETF on board, and that can help hedge your portfolio. But often you end up losing a bit of money on it because you get those snapback rallies. As for shorting individual stocks now, it's like, well, as I was saying when we were talking about the indices earlier, I want to sell before the panic, not after the panic, and that goes the same for shorting as well. It's and that's if I were to short, and as we've discussed, I just don't think it's the best way to make money at this point. I'd rather be just sit tight for a little bit rather than trying to get too adventurous with getting short.
All right, this one seems to be a popular one from viewers of late. Telstra, Telstra.
Wow, look at that. That is holding up remarkably well. Like if well, I'd almost consider buying Telstra. Wonder why that's been so strong. And it's also like, we've got this overhead resistance. We've clearly spoken about this before. So I've got the resistance on, got the breakout, got that nice pullback to the breakout and the 50-day moving average. So this has got a bull market structure. This is sort of structure you expect to see in stocks in a rising market, not in the market which we're currently experiencing. So if I had this stock, I'd very much be happy holding it, and I'd almost consider buying it at this point. It's like, look, it opened at a low yesterday and came straight back up. So someone's buying with intent. What that intent is, I don't know, but it's probably it'd probably be one of the strongest stocks on the ASX over the last week.
Let's have a look at LRK then. Good one. Telstra.
I'd be out. I'd be out of this stock. This was a terrific trend a few years back. It's a real boom stock. I had some during the boom. I've got some drawings on from a previous time. There's my entry point. There's my exit point. So as we spoke about earlier, hanging on for the bust is completely avoidable. So have a plan so you'd never hang on to a bust. And in the environment we're in at the moment, are some stocks going to go into bust mode? We don't know, but it's possible. So you just want to remove that possibility by having an exit plan at some point. I just don't want to hold and hope that things will work out for an individual stock, because sometimes it doesn't, and probably a lot of the time it doesn't. And then just recently, so we had a motion trader signal for it back in October last year, got back above the moving averages, hit a 70-day high, triggered a signal, then just went into a holding pattern for several months, and it's just started to unravel in the last, probably since early March. It's been on the decline and hit its stop loss, I think, yesterday or the day before. So I'd just be out. And Not every signal is going to work out. We can have a nice setup, and I say this a lot, a nice setup doesn't mean a profitable outcome. It's a nice setup has the potential to lead to a highly profitable outcome, but it can also lead to a loss. We just want to make sure that if it's going to be a loss, we keep the loss relatively small. And if it's going to be a great outcome, well, we want to give that every chance to happen by letting profits run and using a wide trailing stop. That's how we keep the equation in our favour over time. But we're going to have these situations where they don't play out, and yeah, I'd be using any rally to exit, and like it even made a new low this morning despite the bounce in the ASX, so it may not even rebound far. It's yeah, it's one I just want to be out of at this point.
NEM.
Let's there's an Aussie listing and a US listing. Just look at the US first. Where to close? It closed mid-range. Like gold's uptrend is still in place. It's something I've been talking about in my weekly strategy sessions on Friday. The trend's still in place, but there are a few things to keep an eye on in terms of like, is there a larger pullback coming? I think with Newmont's been a lagger. It's been one of the worst, possibly one of the worst big cap gold stocks over the last couple of years. You look at a stock like Northern Star or Evolution, or some of the American mid-tier stocks, and they've done much better than Newmont. I think it's okay to hold this stock at this point. But if it can't do well with gold doing what it's doing, it's like I'd be questioning whether this is the gold stock I want to be in. There's no reason in particular to get out other than it's a real lagger within a sector which has been doing really well. If we were to break below yesterday's low, maybe that's a point to say, look, I've had enough with it. It's time to move on. It could accelerate upwards from here, but it just hasn't been the performer. Just quickly on the local listing, yeah, it's got Newcrest. So Newmont bought Newcrest in 2023, and it's taken that listing, and yeah, it's rebounded nicely today. So look, there's nothing wrong with keeping it. But maybe below yesterday's low, it's like maybe there's other gold stocks to consider. But yeah, for now it's okay.
CDA.
CBA.
CDA. DA.
Yeah. Yeah, it's this one will probably it's like it's a motion trader stock. It's above its trailing stop. Probably not by much though. It's probably just hanging above its trailing stop at the moment. And have had a false break higher in February, and the trend pulled back. It's now below these moving averages, which are rolling over. So that's as we've discussed, that's a point of vulnerability. But look, if it's above its trailing stop, which I'm pretty sure it is, well, it is for a motion trader stock, but you might have your own trailing stop, of course. If it's above a trailing stop, I'd be giving it the benefit of the doubt until the stop's breached. But it's not a dip I want to buy because the structural shift that we're seeing from above moving averages to below really needs to hold the line here and get itself back above the averages to re-engage with momentum. But in this environment, it may take some time for good momentum to re-engage.
All right. Next one is ASB.
Yeah, again, relative strength. It's holding up well. Had this sharp pullback to the 100-day moving average and rallied straight off it. It's if I had it, I'd be very much happy holding it. I don't know that I'd be rushing to buy it at the moment, but it does look like there's more upside in it. just by the way it's holding up. There's buying underpinning the pullback, and that's a sign that someone's accumulating, and it's positive for the stock. I think the trend here remains up.
Yeah, good one. All right, we've got about 6 stocks left here, Jace. Let's see if we can get through them all. Next one is we've done ASB. The ASX.
Yeah, it's just in a range, isn't it? It's neither bullish nor bearish, but it's on the wrong side of the moving averages at the moment. I just leave it alone. It's not trending in either direction. It would take a break above at least the late March high, or probably preferably the February high, to say, look, there's some upward momentum. It's breaking to the top side. Until that happens, I just leave this one alone as a stock which is just meandering sideways.
All right, FMG.
Breaking down. I think the same with Rio and BHP. We had this holding pattern around the declining moving averages, but now it's been sold again. Just remember, what's the structure? Declining moving averages, price, rallying back into the averages. Often the rally will be sold, and that's again been the way here. I wouldn't be in it because I would have exited earlier had I been in it. And it's too early to consider for a buy. It's going to take probably like. This could bottom, like maybe this could bottom at somewhere near here, but we don't know. We don't know how much lower it could trend. So I think just at the moment it's not the place to be.
Yeah. AUC.
Yeah, I've got some of this one myself. I bought it last week, and then we had the drop, and I'm still holding what I've got. I'm using the motion trader stop loss on it. Was developing this nice series of rising lows, rising highs, and then the volatility on yesterday gave it a good shake. So it's going to be interesting to see whether it can now recoup those losses and get back to where it was. So I'm happy holding it for now. I'll use the stop loss and see how it plays out.
Yeah, obviously gold has become a bit of a safe haven at the moment. What's your thoughts on buying it in general, gold or silver maybe?
Gold's been the most stable of the commodities. Silver got caught up with the general sell-off in commodities generally. So I think gold is the preference of the two at this point, until silver gives us the price action to have a look at it. But yesterday was a case of sell everything. There's just very rare to find anything green on the screen at all, and gold stocks were caught up in that, even though we've got record gold prices. Like gold's come off a bit from its high. It's like I'm long gold. I've been long gold for a while. I'm happy to stay long gold. But I've been saying in the strategy session that I'm probably not in a hurry to do much adding to gold at this point, because it was getting stretched above its 50-day moving average and looked like a pullback could be coming. And we've actually seen that pullback in the last few days. So it's quickly unwound a situation where it was getting a bit stretched. But I'm happy being in gold stocks at this point. But if people want more on that, just join in the strategy sessions, and I'll talk about it in a lot more depth than we've got time for now.
All right, last 3 here. Let's look at EBR. EBR.
Okay. Again, we're dealing with these sharp pullbacks. It's a bit below the moving averages, but that's okay at this point. Has it hit it's a motion trader stock. Has it hit it actually may have hit a stop loss, because that's quite a deep fall. If it's hit a stop loss, if it's hit a trailing stop, well, I'd be getting out. If it's just held above it, I'd see whether we can get some sort of a rebound. But I'd be, if it's hit a trailing, also if it hit a trailing stop It's possible it hit a trailing stop yesterday. I don't know. If it did hit a trailing stop and I was holding it, just like I've done with TUA, TUA today, I'd use a rally as a opportunity to get out at a better level, rather than holding on and just hoping it re-engages. I just say, look, it's hit the trailing stop, so my exit plan is sell when it hits a stop. So I'll clean it up, but maybe I can get it at a better level. So I'm just not sure. If it's hit the trailing stop, for me, it's an out, but maybe I'd try and get a little bit of a rebound. If it's if it's above the trailing stop, I'd continue holding it, because we have had this overall momentum. This could stabilise. It's not too far below the 100-day moving average at the moment.
All right. FAU.
Is that the right stock? FAU?
That's the one.
Yeah, no. It's really thinly traded. It's just bouncing along the bottom. There's no price action I can really talk about of note with this one. So yeah, Rog, unfortunately, it's there's nothing I can really say here.
Yeah, fair enough. All right, and let's have lastly BHP.
Yeah, it's again, just look at this period through here, consolidating below the moving averages. It's just a point of vulnerability, a point of elevated risk, and this is really unloaded to the downside. I'm not ready to buy it. We've talked about BHP in the past. I bought this breakout back in September. I sold it when it broke lower in December, took a small loss and moved on and done other things. There wasn't a need to be in it. And you can see when you don't need to be there, you don't need to be there. And it's gone to the downside. It's just not a technically strong structure at the moment. Now, like I would have said, it wasn't a technically strong structure in September 2021 as well, and that was near a low, which led to higher levels. But we'll wait for the price action to tell us if the technically weak period has passed, rather than just saying, well, it's weak, so it should reverse. Like, is it going to reverse here, or is it going to reverse at lower levels? You never know until it happens. So until this can stabilize and really start to retake these moving averages, I don't want to know. I just leave it to the side. I'm sure BHP is going to be a great play at some point, but it's patience. It's been patience for months, going, I can't think this is going to be a great play, but not now. And sure enough, it hasn't been now, and it isn't just yet, according to the price action that we can currently see.
All right, fantastic. We've gone through quite a few stocks, and it's been a good mix, I think, of obviously ones that all look the same to the bottom side of their moving averages, and finding that hard stop or being able to sell into the rally if needed. But also some good opportunities in there as well amongst this bearish times at the moment, which is great. Just remember, everyone, everything we say or do here is general advice, as always, right? So if you're got some other reason to hold on to a stock or purchase, then that's up to you. So do your own due diligence, obviously, because and especially in this times, it's important to have your own way of doing things and make sure you stick to your own strategy, right? So thank you very much, Jason. Thanks for everything you've done today.
Yeah, that's been good, Rog. Look, I know it's a really rotten time for probably most people with their portfolios, but like, just try and remember, like, every period is unique in its own way, but it's the same in terms of we get these big pullbacks of 20% or more, 30%, even 50% sometimes. It's like, hopefully this current situation won't go to 50%. But they happen, they come, and then they go, and the world moves on, and markets move to new highs. So I'm entirely confident that we'll see new highs in the future. It's probably not going to be next month, but it will happen. So it's protect the capital and wait for the next round of opportunities to come, and just try and keep out of vulnerable stocks and stocks trending lower in the meantime.
Fantastic. Yep, exactly. Thank you for everyone on the other side of our on YouTube here. It's been great having you all coming in and asking questions and sending your tickers even now, right? So it's good to see that we're still being resilient in these times and being active at the same time, and making sure we're looking after our capital as we continue to teach. We will be back next week as per usual. Don't forget to check out Jason over at motiontrader.com.au, and if you want to ask me any questions at Selfwealth, just send an email to support@selfwealth.com.au. I'm happy to help there as well. Until next week, thanks everyone. Thank you everyone, and we'll see you then. Take care. Bye-bye.